Welcome to the Monocle Banking Podcast, as always curated by Monocle Solutions. This week, we mind the exits as we unpack some very interesting new research from SAVCA and the SA SME Fund that starts to build a much more interesting and compelling picture of South Africa's VC ecosystem. South African venture capital has finally produced some receipts. There are exits and there is cash coming back. There are companies built here that have been bought by the likes of MasterCard, Motorola, Ticketmaster, Nedbank and SAVCA. There's a large fintech on the JSE Optasia. There are founders who have sold businesses and gone into large corporates. They've learned a few things and they've come back looking to invest again. That part of the argument, I think, is becoming rather difficult to dispute. New research from the SA SME Fund, Endeavour South Africa, and the South African Private Equity and Venture Capital Association, SAVCA, examines 226 realized exits between 2009 and 2026. And depending on how incomplete disclosures are treated, it finds that exited investments returned between 2 Rand and 2 Rand 45 for every Rand invested. In the fully disclosed group, a little over 2 billion Rand went in and nearly 5 billion Rand came out. That is a meaningful result. The exit story really is part of several larger shifts that we're seeing in the South African economy, from the rise of more corporate M&A to the shift of businesses going global now. The best South African businesses are increasingly built here, but not necessarily confined to the South African market. We've got Rapid Deploy, which sold emergency response software into the United States and was acquired by Motorola Solutions. And then there's the informal economy, where we're talking about digital distribution in townships and backroom rental housing, all of those good things. And at the center of it really is South Africa's venture capital ecosystem. We're not Silicon Valley. That's a good thing. Our founders operate in a market of sophisticated institutions and very unsophisticated infrastructure. We have affluent customers and profound exclusion. We've got world-class banking technology and millions of people still operating largely in cash. And I think that contradiction is fertile ground for a lot of innovation. So to discuss this, I'm joined by Alison Collier and Antonia Bothner of Endeavour South Africa. We've got Lumka Mlambo, Fund Principal at the SA SME Fund, and Anusha Naidu, who's the Chief Executive Officer of SAVCA. This is the Monocle Banking Podcast, as always, curated by Monocle Solutions, and I'm your host, Michael Avery. Alison, I'm persuaded that South Africa can produce great exits. Maybe not yet persuaded that we have a dependable exit market. Am I being a bit too cynical or cautious here?
When you say dependable, I think if you had made that statement 3 or 4 years ago, I would agree with you. But now, given what we're seeing from the amount of South African corporates, in addition to the international corporates that are actively involved in acquiring the fintechs or the other tech businesses that are built in South Africa, I would say it's now dependable. We've got corporates with large cash balances, and we see definitely in the banking sector that there's a lot of interest and activity that we're seeing in M&A, as well as also just investing into the VC sector from our banking sector. And then the other sectors, the retail sector, Pick n Pay, Woolworths, Shoprite, they've all had acquisitions of different retail tech businesses. I would say maybe the one sector that's slightly slower is in the healthcare and health sector. Recently this year, Nora, the medical AI scribe, was acquired by Healthbridge. But outside of that, there are a handful, but there definitely are more acquisitions in the other tech sectors. And internationally, the large international players, they definitely look to South Africa for some of the bigger tech businesses that we've built. The most recent example is BVNK's acquisition by MasterCard, that's ongoing, but also Time Bank. Their most recent round was led by the largest Latin American digital bank, Nubank, that's listed on the New York Stock Exchange. So for good businesses, yes, the market is dependable. Yeah.
What would you say, and maybe Lumka, to bring you in on this point, what would you say has changed that saw exits improve so dramatically over the last 5 years specifically, compared with, say, 10 years ago? Because there's a very definite acceleration that we've seen almost in 5-year chunks.
I mean, I think the best way to look at it is to look at how funds are structured. Funds are structured over 10-year periods, especially if you're looking at traditional sort of venture capital funds. And so early on, you would have seen, and there wouldn't have been that many funds 10 years ago. I think there's only Knife in South Africa, who's one of the funds that have experienced a full 10-year cycle where they've invested and exited around the other end and a full fund close.
Yeah.
And so I think you are not seeing exits. South Africa is not particularly great at communicating its exits, which is what the study aims to do, aims to put a benchmark in place as to the exits that are achieved. But I think you see those deals that were invested early on. And even in the study shows that deals sort of come to an exit and successful deals come to an exit much later, sort of in a 7-year period. And so the exits that you're seeing now are deals that would have been done 5 years prior or even 7 years prior. And so that's when the market was really starting to go in with sort of focused fund management, as in not just friends and family money, not just being done out of smaller funds or corporate VC. And so the whole market structure is actually changing. And I think as you see more of these funds get out of their investment periods, you'll start to see more exits on the back end as well. Well, this is what we're hoping, and this is what we promise to our investors. So we're working doubly hard on making sure that our funds, such as Endeavour and the others in our portfolio, are working towards that exit. And really the study is to try to put that sort of marker in the ground, is to say South Africa has actually got a really good story to tell. We've not been great at telling that story, but this is our start to do that.
And, we know, and maybe Anusha, that's a good point to bring you in on as SAVCA. We know ever since the amendments were made to Regulation 28 that institutional capital pension fund money can invest greater sums into the alternative asset class, of which private equity and VC infrastructure are classified. Yet it remains difficult. I think the last numbers, and you could correct me, in private equity as a whole were around 4%. And I'd like to know how much of that actually goes into VC, and much less, I'm sure. How are you communicating this with your institutional investors, your LPs and your pension funds? Because now you've got the data. Was this the missing piece of the puzzle up till now?
Yeah, thanks for that, Michael. So I guess even the refinement of Reg 28, that was only a 2023 amendment where pension funds could actually allocate to private capital. So it's still pretty new. The ecosystem is evolving, like we say, the regulation is changing. So currently we see less than 2% of pension fund allocation into private capital, which definitely can be improved to the allocated 15% that Reg 28 actually allows for. So I think research like this definitely helps the cause, being able to share some of the key insights in the private capital and venture capital space. We are noticing a lot more interest from pension fund trustees and capital allocators wanting to engage a lot more with the VC asset class and understanding some of the nuances with investing with VC. So part of our mandate at SAVCA is asset class promotion, as well as capacity building and training. And we're seeing a lot more pension fund trustees ask for bespoke training in private capital to better understand the asset class and to attend some of our conferences and seminars. We had our Gibbs Private Capital Foundation training last week, and it was attended by quite a few pension fund trustees. So I think it's understanding the asset class, understanding the nuances, and getting familiar with the key players in the space, which we're hoping will evolve quite quickly.
And Antonia, just to bring you in on where we're going in the market, at the briefing earlier today, there was a suggestion that the market could double again over the next 5 years. I think Kitso Gordon made that point. Do you think that will necessarily be a good thing for returns? Because, with capital flooding in most asset classes, abundant capital eventually bids away a lot of the opportunity. So what impact might that have on future returns moving forward?
I think at this stage where you are in terms of, the nature of the venture capital market, there is still a lot more room to grow before you're probably crowding out that market. So I think in this case, no, I don't think we're there yet in terms of that supply and demand. And you'd expect, almost because there has become a lot more of a global playing field, where your market to grow in isn't just South Africa. So actually it's more than that. So I think the returns could easily double. And that's not going to take away the opportunity. And particularly the funds have to be disciplined, because if your returns don't come, no more money will follow. So I think the incentive there is to really ensure that those returns, and as you said, you do want to keep that scarce capital. And I do feel South Africa's got that nature, but it's got that nature in the public markets. We've never been highly rated. We've always been seen as quite a value market, not a growth market. So yeah, it would actually be lovely to have that problem, but I don't think we're there yet.
If we look at the 54% median gross IRR in the case studies, I mean, that's an extraordinary number. It's also drawn from selected successful transactions. So what would a responsible expected return assumption for an investor entering a diversified South African VC fund be today?
I mean, I think from all our funds, as we manage various funds, most VCs are promising gross IRRs of between 25 to 30%, right? And so that's what you go in at the fund level. And so obviously the case studies, there's always the risk that you get sort of positive case studies, because the people who have had really great stories are the ones who put their cases forward. And so maybe the story in the case studies is particularly positive. But I think that's what we're promising to our LPs, and the funds typically understand that. And so, I mean, I think when you look at a general VC portfolio, you'll expect to get, using the power law, you'll expect that 20% of the deals will deliver 80% of the results, as it were, right?
Yeah.
And so we're pretty confident that we can deliver that. We've yet to see the full fund cycle in any of the funds that we've managed, but we're on course to look at around 20 to 25%, if not more, in terms of returns. So I think the case studies are a function of the people who put forward the information. And thanks to those people who have put forward the information, because you start to get that kind of detail and granularity coming through to add color to the market. But yes.
That must have been, Anusha, to bring you in, one of the biggest challenges in putting a study like this together, because you're dealing with private markets. I know a lot of the work when I used to work at Dealmakers in trying to track private equity and VC activity was just being able to get access to the data because it's not listed, and parties to a transaction or sponsors don't have to put forward the data. How challenging was it for you to put this kind of data set together?
Yeah, thanks. Incredibly challenging. We understand that the industry is also very busy with doing deals, looking at acquisitions to make, looking at exiting opportunities, looking at capital raising. So it is very busy deal professionals, but this research work is incredibly important. And I think it really is a call to action of what we can actually achieve when people band together and are able to provide that data. For us, being able to present this to the investment community is incredibly powerful. And, this particular study created the impetus from one or a couple of fund managers to actually disclose, and then you had a lot more coming to the party and being able to disclose a lot more. So SAVCA runs the annual VC survey, and I have to say this year was incredibly powerful because we had the work on the back of this research work that we had done, and people were a lot more inclined to provide that information. So I think it really is a call to action. It is important. If we are going to be growing this asset class, we definitely need to have the data and in a standardized format that we can actually deliberate on and showcase.
When it comes to assisting pension funds in how they go about it, what is a rational first allocation for a pension fund that has maybe no previous exposure to VC? Should they be going directly into individual managers? I know we don't have that many managers out there. Do we go fund of funds? Is that the only realistic way to get that kind of diversification? How do you think about this? Maybe Lumka, to come back to you on this one.
Alison and I have had this discussion many times. I mean, I think even the research tells us that the best way for a new entrant to come into a space like venture capital would be sort of through an intermediary, a fund of funds model. The check sizes in South Africa aren't particularly large. And so a big deal would maybe be a 500 million rand check. But there aren't many deals of that size in South Africa. And so I think to get the best bang for your buck in terms of the quality of research, the knowledge, the ability to access these people, is not helpful for an institutional investor who's used to investing large amounts to be looking at a 500 million rand VC fund when they could look to put that to an entity like the SA SME Fund, where we aggregate that capital and then we disperse those to smaller fund managers and then crowd in more capital alongside sort of other South African institutional investors to then disperse accordingly.
Alison, what are your views on that?
Yeah, maybe just building on that. If you look to the large VC markets and you look to how they developed and when they developed, initially you need to have fund-of-fund structures that are the large portfolios that pension funds can write big checks into, and then they can be invested into a mix of different VC funds, some that are focusing on early and seed stage, some that are focusing on pre-series A and series A, some that are focusing on B, some that are maybe even a debt fund that's sitting with the fund of funds. But it makes much more sense for the market to be built up like that. And then a first loss is typically built into that fund of funds to be slightly more attractive for the larger investors that are going into the fund of funds. And then as the VC market evolves, and when the VC market is big enough, then fine, pension funds can go straight to very large VC funds, but we just nowhere close to that in South Africa today. And it would be like a big risk exposure, but also a huge amount of work for a pension fund to go and do that. And I just think the risk return isn't there yet. We'll be there in maybe hopefully 5 years' time, but I think it'll be closer to a decade. But let's see.
Well, heading in the right direction, though, the trend, our friend, in that regard. Antonia, the briefing made, I think, a very persuasive point around what's driving a lot of the exit activity and the fact that local technology businesses have now become large enough to matter to banks in particular. And, you know, it's that kind of scale that not just an outbreak of corporate imagination that is unlocking this. What would you say is really driving this newfound desire within the incumbent, call them banks, insurers, financial services businesses, to go and look for these bolt-on acquisitions? Because 10 years ago, a lot of that innovation and development seemed to be happening in-house. And the fintechs were always invited to the ball, but never, they were always the bridesmaids. But now they're actually putting rings on their fingers, it seems.
I think this is a global trend. You know, I think the competition's heated up. So, you can see it with HSBC and Revolut. Suddenly you've got the technology and the scale of some of these businesses that are offering what customers want. And it just is a fact that it is very hard to innovate within a regulated entity like a bank.
Yeah.
So that innovation always has to happen outside. And you can see that coming through both in the Capitec book and the Time book, which are lovely live kind of examples of that, the speed of the sort of technology. So there are these digital banks which are competing globally. So I think it's a global trend where actually the competition's actually heated up and it's just become an impetus now. Suddenly, the Capitecs and more than, if you want to compete, you have to have these bolt-ons to provide that access to your customer. So I think it's just a part of a global trend actually. And, perhaps we're no longer an oligopoly in terms of the banking sector, which it has always been. But, I think the returns are still very good, which you can see, which means, there might be more to come.
Yeah, and Carl Vestvig described retail capital partly as an acqui-hire. Would you say talent is also now one of the most valuable components of a South African fintech exit?
I think talent in South Africa has always been a big component. I think that's something that's almost under the radar, I think, and it's internationally recognized, actually, the talent. So it was wonderful to hear Carl really highlight that. And it's wonderful for people to understand the fact that you want your talent to remain where they are and not to sort of remove them, which is often the sort of threat. You have kind of a private equity. But I think, South African talent punches way above its weight.
Alison, when we look at exiting to global players, would you say there's still a South African discount when a founder sells locally rather than to, say, a MasterCard or a Visa or another global strategic buyer?
In summary, yes. But if you get the right horses in the race, so if MasterCard and Visa are competing against a local bank for a purchase, then your price will be very different versus if you're only having the local parties competing for you. So you just need to be quite thoughtful with how you go about building up your path to exit, and then include the right different potential buyers in the mix, and then you negotiate the price. So, but yes, in South Africa, the price is lower than what the teams will pay for internationally. And I want to say in many ways that makes sense. MasterCard and Visa, like what I mentioned in the earlier media briefing, they are significantly larger organizations than some of the banks that we have here locally. And so, of course, if they're buying in a tech business, they put it onto their platform, then the reach is that much larger. They can, generate much more value from the transaction. So hence the price. But if you're competing against Visa and MasterCard in a purchase, then you might need to
Yeah.
pay higher than what you otherwise would have as a South African buyer.
I've got to ask you, Alison, as well, and I think we've mentioned it in the past, exchange controls. I mean, do the rules and the tax structures or local company laws still encourage promising founders to move the holding company offshore to Delaware or Singapore, London, or wherever they re-domicile to? Or is that starting to be overcome?
So I want to say, just with how our exchange control legislation, IP's legislation is today, I think more importantly, how the very large organizations globally, which jurisdictions they're happy to acquire from. So because the largest businesses like Google or MasterCard, Amazon, when they're making acquisitions, they want to make acquisitions when the IP is sitting in a jurisdiction that they know well, that they trust, and that won't be any friction to move that IP from that jurisdiction to wherever their business is based. So these businesses typically that we support here in South Africa, they're South Africa founded businesses, they've got their operating team sitting here in South Africa, but very wisely, they have their IP housed in jurisdictions like Delaware, Netherlands, could be London, Singapore, where these international buyers are very interested to look to those jurisdictions to buy from, and that increases the price. The capital still flows back to South Africa because you've got South Africa shareholders that are holding this investment. So our fiscus definitely benefits, and the jobs stay in South Africa. Like that example, where when Rapid Deploy was sold through to Motorola, the tech team that sits in Cape Town, they're still employed, but now employed by Motorola in the US, but they're based in Cape Town.
Yeah, that really is, a good example. How common is that outcome across international exits? Because that Rapid Deploy story really stood out for me. And what functions tend to remain here versus then being shipped offshore?
Typically, businesses have already that are global that have been built in South Africa. A lot of the sales function sits in whichever market their customers are. So that typically is, wherever, in whatever global market or markets the business is. But the tech team or the back office typically stay, if it was a South African founded business, sits in South Africa. And why does it stay in South Africa as the business expands? And also, why does it stay in South Africa even after the business is acquired? Is because the relative value for money that you get for the quality and skill of the South African tech team or the sort of the supporting operating team, it's an incredibly good value for money. And South Africans, we also sit, I'm going to say very practically, our time zone is like it's pretty much in the middle of the world. So you can support the US and you can also support Southeast Asia really effectively from a time zone like what we sit in. But the most important is the skill of the South Africa workforce and the value for money. And mostly it stays. And we even see after acquisitions, then teams go, they realize, the international teams, how skilled the local talent is that we have here. And some more functions along similar lines are moved to South Africa too. So we've got cases like that in the tech space, and we've seen that with a few of the businesses that our Endeavour Global Capitalist Fund is invested in. Good story for South Africa.
Great story. I mean, we've got the talent as globally exportable, and increasingly we can exit at a decent return. There's also, the briefing widened the aperture of the lens a little bit, and Lumka, to bring you in on this point, to township commerce. It was interesting to hear Ketso speak about Indlu and the recent bond issue with RMB as an example of, and this is funding backroom rental housing. I was chatting to the transactor Alejandro Escalco about the deal a couple of weeks ago. Fascinating transaction, really impactful. I wasn't aware of the role the SA SME Fund played very early on in that story. So how much of the SA SME Fund's portfolio genuinely reaches the informal economy? Because there seems to be a big opportunity here. And just the other day, we had Pepco announcing a fintech deal that plays, again, very much into that economy. 200 billion rands worth of annual top-line revenue flowing through that particular business.
I mean, I think Ketso addressed it quite well in the briefing earlier, but I'll just repeat a little of what he said. Our role in Indlu was in our first fund, where we had a debt portion, and we were able to seed Indlu Living, which is what really venture capital aims to do, is to come in as an early check and sort of allow them to prove their model. They did that successfully, really great team at Indlu. And I think what then bolstered that was the fact that people are able to see progress, and RMB comes in. FREF, which is part of RMB, provides sort of early support financing, which is then able to leverage the RMB financing. So that was a really great model. But in terms of all the other stuff, I mean, a lot of the businesses that we support in our VC funds are tech and tech-enabled businesses. But I think Alison mentioned that if these are fintech businesses, they're providing access to capital. This access to capital is across the board in South Africa. Companies like Yoko providing payment systems that allow anybody in South Africa to be able to access credit cards. And so it may not be that the businesses in venture capital are directly in townships, but a lot of the solutions that they solve for and pain points that they solve for are for the problems that are experienced across the board in South Africa, township markets.
Yeah.
Access to capital, access to health, access to retail services.
And we know those are certainly then scalable, in other emerging markets as well. And one could look at Brazil, India, and other places for growth. Just as we are running out of time here, maybe it's best just to go around the panel and ask you what surprised you about this research, because you obviously go in with an assumption or an expectation, and then you get the numbers back. And was there anything that really jumped out at you? Maybe let's start with you, Anusha.
So for me, I think what was very exciting was the delivery of that data. Sometimes as South Africans, I think we don't actually scream from the rooftops when we do something really, really great. We have a bit of a modest culture, I guess, and actually seeing the numbers come out and seeing these success stories. I think what's incredibly inspiring in venture capital is that technology innovation, the jobs created, and then that flywheel where you have founders who go back after exiting and actually recalibrate the system and start their own funds, and they come in as transaction advisors. They have that confidence, they're building that ecosystem so incredibly well. So you see that on repeat, and I think that was, for me, just incredibly powerful.
Lumka?
Yes, I think the data was really great for us. It confirms our conviction in the asset class, that this is an asset class that deserves support, that it is going to drive innovation and R&D and future great companies in South Africa. And more importantly, that you can see exits, which is what our job is, to go to institutional investors and show them that this is viable. And so, yeah, we were quite thrilled with the results of this data. We weren't actually expecting that it would be quite comparable to some of the international markets. So that's great news.
That certainly surprised me. Antonia?
I think for me, this takes time, but it's worth it. So I think you have to keep that narrative, because these are cycles as well, but I think there is so much more to do. And to see the number of local investors that are going to be benefiting from these exits, not just in sales, but in an option like listing, like Optasia. For me, that's incredibly beneficial. The fact that you have these avenues of liquidity for return that can be reinvested. So I think it does take time and a lot of hard work, and they should be earning their fees in this asset class, if anyone. So I think a lot more to come.
Yeah, if any asset class, needed to reward patience and grit and actually rolling up your sleeves and getting into the operational day-to-day of the businesses you're investing in, it's completely different to any other asset management that one can compare with. Alison, just lastly, you get the final word. What stood out for you? What surprised you in the research? We didn't really even touch on AI, which is probably a whole conversation on its own, but what surprised you?
So I want to say what surprised me is we were expecting to see this growing trend of exits with interesting and really strong commercial returns that would be attractive. But what surprised me is that the pace of the growth of those exits is so much faster than what we had anticipated. Like in the last 2 years, 3 times the amount of exits that they were 2 years prior or 3 years prior. And then again, 3 times faster than the 5 or 7 years prior. And the teams are now, I would say in the early 2010s, the teams weren't necessarily staying in South Africa. Now, because the ecosystem is that much more developed, the teams that are exiting, majority, 80% of them are staying in South Africa. They're building their next business. So we're getting a much faster recycling and multiplicative effect of both the founder experience and founding teams experience, as well as the capital that comes with it. So when you see a trend accelerating, increasing at this pace, it's very exciting, especially when the founders are staying. So yeah, and growing interest from the banks. When that happens, it's definitely good news.
That's when you've arrived. And something that you referenced, Knife Capital, I think Keert van Zyl, when I spoke to him, must have been about 8 or 9 years ago. He was lamenting the fact that wasn't yet evident in the ecosystem. It is now, and I think a very important milestone, the fact that South African VC has really proven it can produce serious companies, credible exits, and continues to attract great capital and skill and shows the requisite ambition. I think if we could just get some of those barriers like ex-cons and a few other things from Treasury relaxed a little bit more, who knows what we could do in the next 5 years. But my thank you very much to Alison Collier, Antonia Bothner, Lumka Mlambo and Anusha Naidu. This has been the Monocle Banking Podcast, as always curated by Monocle Solutions. I'm Michael Avery. Until next time, take care.